The goal for every single investor is to maximize their returns. And what better way to measure that returns that you obtain than against a benchmark? Well, the most common benchmark that is used is the S&P 500, which, as the name indicates, it contains the 500 largest companies in the US. So this right here is what we're seeing right now. This year it has performed really well, but today we will actually be looking at 8 stocks that have consistently beaten the S&P every single year for the past 5 years. The first stock on the list is a medical devices company called Dexcom. It has a return on capital employed of 7%, which is a little on the low side. I generally want to look at companies which have a return on capital employed higher than 10%, so this would be a red flag for me and I would not invest on it. But regardless, it has great interest coverage, which means it's safe from the liability aspect. It has amazing cash conversion, which means that the investor gets a lot of the income that it creates back as free cash flows. Has amazing profit margins with a 65%, and it has okay operating margins. You usually want to see this number way above 15%, but this should be safe and sound. In terms of its financial metrics, you can see that the return on equity, on assets, on sales, and on invested capital are very, very consistent and have been increasing recently, which is a sign of prosperity and good future for this company. In terms of valuation, you can see that on a PE ratio right now, it's trading as a premium because it is a company that does historically show a great growth. So I think this is priced into the company. And in terms of free cash flow yield, using 2022 data, it does seem very expensive. Now, SPS Commerce is a supply chain operations retail company with a return on capital employed that is a lot better, an 11%, an interest coverage ratio of 100, which means, again, it has no liability risk, great cash conversion, an amazing profit margin, and an okay operating margin, which is above the threshold of 15% that I spoke about in the last stock. In terms of financial metrics, again, this company is extremely consistent, which is number one, very hard to see nowadays. And number two, you can see its return on invested capital has been increasing at a very fast pace from March 2020 all the way to now. It's gone from a 35% all the way closer to a 60%. Shows that the management is actually doing the correct things with this company moving forward. In terms of the valuation, again, this company is also trading on a big price to earnings ratio, since it also has very high growth rates, and since the financial metrics are improving so much, this is priced into the stock with a free cash flow yield of 1.13% according to 2022 numbers, which is again a bit expensive for a company. The next one is Deckers Outdoor Corporation. Of course, you will probably know this one. It trades under the ticker symbol DECK, with a very, very good return on capital employed of 25%. This is something you really want to see on a company if you're going to invest in it long term. Interest coverage ratio of almost 200 times, meaning zero liability risk for this company. Cash conversion of 82%, meaning there is room to run for them to improve their conversion of net income into free cash flow yield. They have a very good profit margin of 49% and a solid operating margin of 18%, a lot better than the last two previous companies. In terms of financial metrics, again, extremely stable company, and look at the latest quarter in September 2023. The metrics shot up drastically, which was incredible, and this is one of the reasons of why it is trading at a premium right now. It's trading at a PE ratio of almost close to 30, which is the highest it's been trading in terms of PE ratio since before 2020. And in terms of free cash flow yield, it is not that expensive. It is at a 2.56% comparing to a 3% of the long-term inflation rate. The next one is called MedPace Holdings, which is a pharmacology and laboratory services company. It has a great return on capital employed of 20%, double of what you should be usually looking for, or the minimum. An amazing interest cover, so no liability risk. Great cash conversion, so it's good at creating free cash flows for the investors. And then it has a small profit margin of 28%, but it is great at converting that into operating margin of 18%, so I'm happy with that. In terms of financial metrics, again, extremely stable. The only thing is that you can see the return on invested capital is huge because this graph is on a logarithmic scale. So the return on invested capital for some reason is around 7,000 to 8,000%. I would just stick to the other metrics, the return on equity, return on assets, and return on sales, which all look amazing for this company. In terms of valuation, this company looks all right. It looks fairly priced, right where it should be. It looks, in terms of PE ratio, it's a lot higher than it's been all the way from 2022 up to now. However, it's back to the levels of 2020, 2021, where it was trading at a bigger premium due to its higher growth rates or expected growth rates. The free cash flow yield is currently higher than the long-term inflation rate using 2022 numbers, which shows that this company is at an attractive price right now. The next one is Cadence Design Systems, which provides electronic systems. Again, an amazing return on capital employed, 21%, great interest coverage, amazing cash conversion, and this one has the best margins of them all right now, with almost 90% for the profit margin and an operating margin of 30%, which is incredible. And the reason why we're looking for profit margins like these is because if there are any incoming pressures from either competitors, from an economic downturn, or anything like that, this company will have a greater chance of survival and being able to handle either price drops or increases in prices of raw materials. In terms of financial metrics, again, another company which has been doing great on their financial metrics. And this is very usual to see on the companies that we're seeing on this list. But this is because, of course, they're the best of the best. They have been outperforming the S&P 500 for the past 5 years, every single year. So you can see that the return on assets, the return on sales are sitting at around 30%, which is pretty good. And in terms of valuation, of course, this company trades at a huge premium, especially now. It's trading more expensive than all the time before 2020 at a free cash flow yield of 1.5%, which is a half of the long-term inflation rate. Shows that this company is trading at an expensive valuation. But of course, with those fundamentals and financial metrics, who wouldn't buy this company if it was an attractive price? Now, Synopsys is a company which focuses on silicon chip design, with a lower return on capital employed of 12%, but the other metrics, of course, look insane with a 100 times interest cover. This has no liability almost, cash conversion of 132%, great accreting cash flows, profit margin of 80%, which is extremely healthy, and an operating margin of 22%, which is really good. In terms of financial metrics, again, extremely stable with increases in the previous 2 quarters, which have caused, of course, for this company to trade more expensive from April 2022 to now December 2023. It is trading at a premium right now, 1.9% free cash flow yield against a 3% long-term inflation rate, but I think this is a company to keep your eye on in case the price drops. Now, for Lattice Semiconductor Corporation, this has the best metrics out of all of them. Again, a return on capital employed of 23%, 45 times interest coverage ratio, which means no liability risk, cash conversion of almost 130%, profit margin of 64%, and an operating margin of almost 30%, which is extremely healthy as well for a semiconductor corporation. Again, amazing financial metrics. Look at how they have increased since 2021. And in terms of valuation, it has decreased. It is trading more or less in terms of PE ratio cheap right now. In terms of free cash flow yield, does not look attractive yet. But one thing to note about this company is look at the EPS on the chart. It has been getting stagnant recently. And I don't like semiconductor companies because they're usually very cyclical, and I try to avoid those. And finally, TFI International with a 16% return on capital employed, 12 times interest cover, and 100% cash conversion. This company focuses on transport and logistics services in Canada, the US, and Mexico. And that is why it has very low profit margins, because this is a very low margin business. And in terms of PE ratio, I couldn't get the other graphs, so I got this one. It's trading at a very hefty premium in terms of PE ratio. And in terms of free cash flow yield, in comparison to last year, it does look very attractive. But before we move on, please remember I'm not a financial advisor and this isn't financial advice. Please do your due diligence before buying any of these stocks. Thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trader Republic or Trading 212.